Taxes are going to be one of the largest expenses of your lifetime, and while you have to pay them, there are legal ways to reduce your tax bill. I'm Chad, a certified financial planner here in Canada, and after 13 years of helping people with their money, I can tell you most people are paying more than they need to. Not because they're doing anything wrong, but because no one has ever showed them how to pay less. Which is why in this video, I'm going to break down exactly how the Canadian tax system works, then walk you through the strategies that can actually save you thousands. Let's get into it. Now, everybody's tax situation is, of course, different, and if you want me to look at your specific numbers, there's a link in the description to book a call. It comes directly to me. But first, let's break this down. Before we get into strategies, we need to be clear on how our taxes actually work because many people get this wrong. There's a myth out there that if I earn more and I move into a higher bracket, I'm going to take home less money. That is not how it works. You will never take home less money by earning more. In Canada, we have what's called a progressive tax system, meaning that as you move up in tax brackets, you will only pay the new tax on the money in said tax bracket. Let's look at a simple but silly example. Let's say there was two tax brackets, and from $0 to $10,000 of income, you were taxed at 0%. And from $10,000 to $20,000, you were taxed at 50%. If you made exactly $20,000, you would not be paying 50% on the entire amount. You would only be paying 50% from $10,000 to $20,000, meaning that your marginal tax rate or the tax on your top dollar is 50%, but your average tax rate would only be 25% because you're only going to be paying 50% on half of that income. This is a very key distinction between marginal tax rate and average tax rate that I'm going to be coming back to later in this video. Now, understanding this is the foundation to everything else. Every strategy I'm about to show you is designed to either reduce your taxable income or shift your income into a lower tax bracket. So now that you know how the Canadian tax system works, let's talk about the most powerful tool that you have access to and can drastically reduce your taxes. That's registered accounts. Registered accounts are not just savings accounts, they're tax shelters, and using them strategically can save you tens of thousands over your lifetime. Let's start with the RRSP. Contributions to an RRSP reduce your income dollar for dollar. So, for example, if you earned a $100,000 salary in Ontario and put $10,000 into an RRSP, you would now be treated tax-wise like someone who earned $90,000 in that province. In 2025, this would have saved you $3,091 in taxes. Now, once in the RRSP, the money grows tax-free inside of the account. You pay taxes only on the withdrawals once you're in retirement. You don't pay taxes on buying or selling investments in the meantime or dividends, just the withdrawal in retirement. So the question everybody asks is this actually worth it? Let's go back to the marginal versus average tax rate I was talking about before. When you contribute to an RSP, you are saving at your marginal rate, your top rate today. That's your highest bracket. When you withdraw in retirement, you're paying at your average tax rate then, which is almost certainly going to be much lower. Let's look at an example. For the example, let's keep it simple and let's stick to the $100,000 income earner in Ontario. The marginal tax rate on this income in 2026 will be 31.48%. But notice here on the screen that the take-home income is about $78,000. So it's reasonable to assume that this person will be spending somewhere between maybe $60,000 to $70,000 in retirement. So that is the number that I'm going to use to build into a projection if I did a financial plan. So again, assuming this person is over 65 in retirement, there'll be a great deal of tax credits, more on that later, that will come into the picture. So taxes will be very favorable as well. So now a single person looking to spend about $60,000 will need to draw an income of around maybe $70,000 before tax. So now note here that on $70,000 that the average tax rate, the ATR, is only 17.37%, meaning that this person has received a refund today of 31% in order to pay 17% in the future. That's a 14% spread to this person's advantage. In other words, they've created 14% of wealth on this transaction simply by putting money in a specific spot. Now let's take this one step further, add income splitability if this was a couple, and now the individual no longer needs $70,000 of income, more like $35,000 each. Now if we look, the average tax rate's more like 10%. If your marginal tax rate is 30% or more and your average tax rate in retirement is 10 to 15%, that's a 10, 15, 20% gain just from the tax difference before we even talk about investment growth. No wonder the RRSP is so powerful. Next would be the TFSA. Now, contributions here are after tax and you would get no deduction on your taxes today, but the money gets to grow tax-free and withdrawals are completely tax-free forever as of today's tax code. It's really best for flexibility for low income earners, or if you expect to be in a higher tax bracket in future years. If you're under the age of 50 or so, a great goal for you could be to retire with about 50% or so of your investments tied up in a TFSA. I'll tell you from experience that having a great, big, fat TFSA in retirement makes manipulating taxes a heck of a lot easier for those clients that have helped do so. Lastly, we move to the FHSA, or the First Home Savings Account. Now, the tax deductions here are similar to an RSP. The growth is tax-free and the withdrawals are tax-free, but it is only for those of you that are first-time home buyers. You get about $8,000 of room per year and $40,000 of lifetime limit. So if you are 18-ish years old, or you know someone who is, get them to open an FHSA now, even to leave that account empty, because you do not accumulate that room unless the account is already in place. So which should you prioritize? Well, it really depends on your tax bracket now versus what you expect your tax bracket to be in retirement. Quick rule of thumb, if you're a higher income earner now, RSP, and I'm talking marginal tax rate of high 30s or higher, RSP is a no-brainer. For lower income earners, the TFSA offers flexibility. And also remember, you can always take money from the TFSA and move it into RSP come RSP season or in later years if that's what you should have done in the first place. If you're buying your home, FHSA also seems like a no-brainer for me. So registered accounts are your first line of defense, but there's more that you can do, especially when it comes to deductions and credits that most people miss. Tax credits are your friends, especially once you are over the age of 65. Here are 3 key tax credits that I like to go through with all of my clients. The first would be the personal amount. Now this, everyone gets. I get this. An 18-year-old working at Dairy Queen gets this. You get this in retirement. In 2026, the personal amount is $16,452. Next is the pension amount. This is eligible on any pension-related income, so RIF income, LIF income, pension income, etc. And it's $2,000 per year per person. Lastly, the one that most people miss is the age amount. In 2026, the age amount is $9,208. Now, to be fair, this one is income tested, so you may or may not qualify for it, but many retirees, in fact, the vast majority do qualify for some, if not all, the age amount. If we put all 3 of those together, the total is $27,660 of non-refundable tax credits each. So for a couple, that's $55,320. That's a lot of income that you get to erase off the bottom of your income statement to save you on taxes. It's a great thing to have in your pocket. Now, if you're in a couple, there's another strategy that you can use to save even more, and it's one of the most underused tools that I see, and that's the spousal RSP. A spousal RSP is just like an RSP, which I just explained, except you get to take advantage of some more tax manipulation. You get to put the money in the name of the smaller income earner, while the larger income earner gets to take the tax benefit today. Talk about a big win if you have a large gap in your incomes. On the withdrawals, there'll be tax to the smaller income earner as well. Now, this is underused because income splitability has wiped out some of the advantages of this type of account by just allowing you to split other income. But it's always a nice tool to kind of balance assets between a husband and a wife. And again, especially when there's a large gap in their income. All right, so we're on to the last strategy to help you legally pay less in taxes in Canada. And this is a big one for a lot of Canadians. Let's talk about real estate. The reality is that for many Canadians, the home that they live in will be the biggest asset that they have transitioning into retirement. And fun fact, it's 100% tax exempt in today's tax laws. I have sat with many clients who paid between $100,000 and $200,000 for their homes in something like the GTA or maybe Vancouver area, and it's now worth over $1 million. Outside of a TFSA growing for another 40 years, there's no other tool that can help you access as much capital tax-free as your primary residence. The nice thing is any bank will also allow you to use it as collateral. So as long as you're responsible, you have to be responsible. For the numbers here, you can always get a home equity line of credit and lean on a percentage of the equity in your home. And this income will be tax-free because it's loan-related income. But again, you have to be responsible with that. Now you know how to legally pay less taxes while working and saving. But what about when you retire? That is exactly why I made this video right here, where I break down exactly how our retirement income gets taxed and how to keep more of it. I'll see you there.